Fragility in nature is a dangerous characteristic, and it's also dangerous to your financial well-being. Now, dinosaurs were large and powerful, but they still died off. Why? There's no shortage of theories about what led to their extinction, but we do know that the dinosaurs' inability to adapt and survive major shocks was a contributing factor that led to their extinction. One of the major lessons among many is that being large and being powerful all by itself is not a guaranteed formula for survival or even thriving. Now, in Nassim Taleb's framework, his Antifragile framework, things that are fragile are negatively impacted by disturbances. What kind of disturbances are we talking about? Well, it can include a host of disturbances, including chaotic events, unpredictable shocks, black swans, or what I like to call or refer to as black pianos from the sky. Black pianos falling from the sky. I prefer that over black swans. I think if a black swan landed on you, it would be a lot less hurtful than a black piano falling on you. What do you think? But fragile objects, by definition, are easily broken during times of chaos. Now think about how a delicate vase reacts during an earthquake. The vase is easily damaged with just one violent shake. It's irrelevant how beautiful the vase looked before the earthquake or how long it took the artist to design the vase. The vase falls victim to the destructive forces of being fragile. Now, getting back to dinosaurs, the extinction of certain creatures from nature provides, I think, ample evidence that fragility is a destructive force. Now, other fearsome species, you think about it, like the saber-toothed tiger and the thysaline, they suffered similar fates to the dinosaur. But for whatever reason, their fragility led to their permanent demise. Now, from an investment perspective, the loss of capital caused by external shocks, it extinguishes money in a frailly built portfolio. Now, in the context of your investments, whether they be for retirement or another purpose, fragility is an acute threat to your financial well-being. Now, the opposite spectrum of fragile are things that resist the dangerous forces of fragility. Taking that one step further, these are things that can gain from chaos or benefit from chaos. We can describe these sort of objects or things as anti-fragile. So the benefits of designing an anti-fragile investment portfolio are only appreciated when everything seems to be going wrong. Instead of breaking during times of massive chaos, massive volatility, and a multiplicity of disorder, what happens to the anti-fragile portfolio? What does it do? How does it react? It benefits. It goes up. Whereas the fragile portfolio is vulnerable to losses. So this is a framework that I describe in my online class, Build, Grow, and Protect Your Money, a step-by-step guide. And also there's another course, sister course, titled Profit During Crashing Markets, a step-by-step guide. And they both cover aspects of anti-fragile investing, but I want to talk about some real-world application because the root of anti-fragile investing is very philosophical in nature. But I want to take it from that philosophical leanings and convert it into real-life, real-world application. So I want to talk about the components, though, of the anti-fragile portfolio that allow it to gain when markets are declining. Let me just give you an example. Inverse ETFs, which are designed to increase in value when market prices fall. This is a prime example of a component within an anti-fragile portfolio. Now, beyond stocks, inverse ETFs cover an array of asset classes, including bonds, commodities, real estate, even currencies. you can find inverse ETFs covering all of these asset classes. So it doesn't just have to be a declining or chaotic stock market where you can benefit with inverse ETFs. It can be a declining or chaotic bond market, or declining or chaotic commodities market, or declining and chaotic real estate market, or declining and chaotic currency market. So inverse ETFs come in three basic iterations. You've got your unleveraged funds, which do not attempt to magnify their performance. You've got your 2x or 200% leverage funds. Those are daily. And then you've got the 3x versions or 300% daily leverage. Those are the three basic iterations of inverse ETFs. Again, unleveraged, 200% leverage, and 300% leverage. Those leverage points, again, are daily. And by the way, be sure to sign up for ETF Guide's Inverse and Leveraged ETF Guide. It's free. It publishes every quarter. Just go to etfguide.com/snapshot, and you can get that guide. It contains the realm and spectrum and category universe of inverse and leveraged ETFs. Now, another type of component within an anti-fragile portfolio are put options, which can also benefit from chaos. Instead of being damaged, put options actually thrive and grow during external shocks. And so let's get deeper into the real-world application. The real-world application of anti-fragile investing. Remember, the orientation of an anti-fragile portfolio is not accidental. Like a carefully engineered bridge, its existence only occurs through a series of deliberate steps that are consciously planned. Now, for the one-dimensional investor with a long-only or buy-and-hold slant, both put options and inverse ETFs are the types of assets that benefit from large external shocks and can complement the portfolio. Moreover, they provide the discerning investor with plenty of financial flexibility. Instead of liquidating an entire portfolio and incurring a large tax bill, along with potential brokerage trading costs when financial markets go haywire, the discerning investor can simply insert anti-fragile components into their long-only or buy and hold portfolio. These anti-fragile components, again, like the inverse ETFs, put options, with the purpose of offsetting any potential gains or any potential chaos or losses that can come from that. And it actually balances out very nicely these one-way long-only positions. So a portfolio, and I think this is important to mention, the portfolio that holds 100% of its assets in cash, is that by definition an anti-fragile portfolio? What is your answer to that question? I'm going to pose it again, and just think about this in your mind. A portfolio that holds 100% of its assets in cash, is it anti-fragile or not? Well, the answer is it is not anti-fragile. And that's because the only benefit provided to the investor is stability, not growth. By design, an anti-fragile portfolio will grow in value during turmoil or turbulence. And so a portfolio that's 100% cash, when markets are declining, it's stable, but it's not really growing or benefiting from that instability in the markets. So that is just to help you understand that. So to recap, anti-fragile assets that benefit from turmoil are put options, inverse ETFs. You also have volatility ETFs and volatility call options. What type of investment portfolio do you have? Is it fragile or anti-fragile? Whatever the case, hopefully it employs the type of investment approach and strategy that can thrive during any kind of market conditions, especially unfavorable ones. If you enjoyed this episode, be sure to join ETF Guide Premium. Just go to etfguide.com. Also, check out our free ETF guides and our online courses. Until next time, be safe.